A gap is simply when price opens above or below the previous price closure. Gaps are mainly found when trading the stock market, but they may also be found in the Forex market. Major currency pairs don't create gaps that often, whilst cross pairs and exotic pairs do create gaps more often. Gaps can occur between the various sessions, at the daily closure of price, and at the reopening of the market after the weekend. One of the major currencies that likes to open with gaps is the New Zealand dollar. In fact, it is defined by some as an exotic major pair. Exotic pairs create the most amount of gaps, because they are much more volatile. When trading exotic pairs, it is recommended to keep a low percentage of risk, with a stop-loss positioned at a strategic distance, giving space to the price movement. When gaps are formed, they tend to be filled back up or down. This may happen immediately or it may take some time, but in both cases it will get filled. If a gap occurs and it is getting filled immediately at the reopening of the market, or after the daily closure, be aware that spreads may be very high, and you should avoid entering the trade. If instead the market doesn't show signs to fill in the gap immediately, it will then act as a future target, when price will confirm its new direction. If you are a short-term trader, be aware of gaps because they might temporarily influence your trade. If you are a long-term trader, gaps will not influence your trades because you have bigger targets. It all comes down to using a correct risk management for your trades. If you apply a correct risk management, you will not have any problems even when gaps are formed.